The reason you want to own gold, or the reason you want to own silver, is because they cannot default in a world that is defaulting.
Who does it matter that the U.S. government is insolvent? They have no money. So where do they go to get money? They have to take money from the private sector to finance the debt and deficits and the interest on the debt, which is now $1 trillion a year. And again, the catalysts are there. A very positive real Fed funds rate, the ending of the bank term funding program, and the reverse repo facility running dry. Those are your catalysts. Doesn't guarantee it's going to happen.
Bill Holter, a seasoned expert in precious metals, shared his insights into the shifting dynamics of the gold and silver markets. He points to a supply-demand imbalance, highlighting the significant transfer of these metals from the west to the east, tightening supply in the west and driving up prices. Holter also voices concerns about the integrity of gold holdings in ETFs, hinting at the existence of synthetic gold, which could mislead investors about the true physical backing of their investments. Holter delves into the potential manipulation within the financial system, emphasizing the risks associated with the lack of transparency and genuine asset backing. He advocates for the tangible value and reliability of physical gold and silver as investments, especially in a landscape marked by financial uncertainty and systemic risks. Reflecting on the historical significance of gold and silver as foundational elements of financial systems, Holter sees them as enduring pillars of stability. His perspective underscores the importance of physical ownership of these metals as a safeguard against the unpredictable shifts and inherent vulnerabilities of the modern financial ecosystem. Now, we'll show you more clips of Holter, but first, like, subscribe, and turn on notifications, as those who watch our videos are better informed. Enjoy the episode.
Commercial real estate loans coming due in the next 2 years. So the banks were in trouble when they launched the bank term funding program in March of 2023, and things are much worse than they were when they first launched the program. So I put out a tweet the other day about the real Fed funds rate, and the real Fed funds rate went from -8 to +2 percentage points this time around. And every time in the past few recessions, when the real Fed funds rate, so the nominal rate minus inflation, poked its head above 2% and stayed there for about a year, we had a recession. Well, we're about 9 or 10 months now of a positive 2% real Fed funds rate. And again, in the other instances, the negative Fed funds rate was, maybe just slightly negative, maybe -1. It was never -8. We went to ZIRP, zero interest rate policies, and had a 9% inflation rate, 9% inflation rate. So this is an unprecedented increase in the cost of money. And the banks are hurting because their loans that they've made, most of them were real estate related loans, especially on the regional banking sector. They had their assets taken from them, and the 10-year note is higher than it was when the assets were first taken from them. And mortgage-backed securities, the mortgage rate now is 7%. It was 6.6% back in March of 23. So the banks are in trouble. 4 banks went under in 23. The Fed bailed them out, and that program ended on March 11th of this year. So, and last week wasn't a great week for the stock market. I anticipate a liquidity impulse that will be greatly negative. Starting, it's not going to be a trenchant, watershed moment like it was, say, Michael, March 12th, he said the liquidity crisis is coming. What I am saying, Dunnigan, is that the reverse repo facility, now it has $400 billion in it. It started with $2.5 trillion about a year ago. So that should run dry around June. And then all of the easy money that's been pouring into the stock market from the offsetting bank term funding program and the reverse repo facility, that actually wiped out QT. So QT has been draining the Fed's balance sheet. And the QE coming from money that was fallow at the Fed and the reverse repo facility coming into the stock market and the bond market has more than offset the QT. So you actually had a form of QE, about almost $1 trillion worth over the past year. So that ends in June. And then I would expect to see some reality come to this very, very frothy stock market. In fact, my estimation is that the stock market is still 40% overvalued. So I expect reality to come. I'm monitoring financial conditions. They've stopped easing. They're not tightening yet. But before they can tighten, they have to stop easing. So the last 4 weeks, financial conditions have stopped easing. So I'm myopically focused on that. And I'm also looking at credit spreads. Credit spreads have yet to widen. I expect that to happen again late spring, early summer.
It's probably supply oriented. We've seen a premium in Shanghai of $30 to $50 an ounce over COMEX and LBMA for the last, I don't know, 4, 5, 6 months. And it's a clean arbitrage. So what's happening is inventory is moving from west to east, and I think that's finally beginning to really tighten the supply in the west. And if demand even stays the same and supply shrinks, you'll see higher prices. So I think that's what you're seeing is the arbitrage is finally starting to take effect. You've seen a rally over the last month or 2 months. You've got gold now, what, 2150 or thereabouts. It's a clear breakout. Wouldn't surprise me if we traded back down to 2070, 2080, test the breakout level and then take off. Once this gets rolling, silver is going to be gold on steroids. I do want to add one thing. We've seen over the last probably 6 months, and even longer actually, we've seen the amount of gold supposedly held by GLD, by some of the ETFs. We've seen their position shrink. It's continually shrunk. And it's my opinion, if you read the prospectuses on a lot of these ETFs, they don't have to hold physical gold. They claim to hold X amount of ounces. My question is, are they real ounces or are they synthetic ounces? And my thought process is they understand what's going on behind the scenes. And I think what you're seeing is a closeout, if you will, of some of the games that they were playing. And that has affected the inventories of some of these ETFs. They're starting to dry up. So, I don't have any direct evidence of that, but my sniffer tells me that a lot of this gold is synthetic, and as they're unwinding some OTC positions, the long side obviously has to go also. So whether the long side is real or whether it's synthetic, I'm not 100% positive, but I suspect, as is everything else in the world today, I think the inventory numbers for years have been fabricated. Failure to deliver or failure to exist will create a problem similar to or even greater than what happened in the nickel market 2 years ago. So, I mean, you could wake up one day, and if you remember what happened with nickel, it was up over 100% in less than 2 days trading. So, yeah, I do think that that's likely. You mentioned solar demand. The Silver Institute just came out with numbers of 1.2 billion ounces of demand, and the supply we know is just a shade under 1 billion ounces per year. So that's showing a deficit. But I think the Silver Institute numbers are way incorrect because there was well over 300 million ounces used just in solar. So, if you add in the other uses and investment demand for silver, I suspect the deficit is way more than 300 million ounces.
In today's market recap, silver price forecast facing downward pressure under 2480 time to sell. Silver's market dynamics have shown vulnerability with the commodities price at 2455, reflecting a cautious stance from investors. Let's take a look at the impact of recent U.S. economic data. Unemployment claims remained stable at 210,000, suggesting labor market resilience. Philly Fed Manufacturing Index turned positive at 3.2 against an expected 2.6, hinting at manufacturing sector health. Flash PMIs for manufacturing and services outperformed forecasts with readings of 52.5 and 51.7 respectively, indicating economic robustness. Now we'll show you more clips, but first hit the like button, subscribe to the channel, and check our pinned comment. Enjoy the video.
Seen, well, you seen that was 7 stocks. Now it's about 4 stocks. The Magnificent Seven has become the Magnificent, 4 or 5 stocks. So the breadth is becoming more and more narrow. And every time in the past you've seen that happen, whether it was in the Nifty 50 in the 70s, or if it was the NASDAQ stocks in 2000, every time a very small number of stocks lead the gains, it's led to disaster. Now that's not a timing tool though, Donegan. So again, I think I've been doing this for 33 years. So I don't think I'm an idiot. You can ask some people, I'm sure they think I am, but I don't think I am. And I manage a lot of money, and I have a lot of money personally. And I don't want to get blindsided by either being short the market too early or out of the market completely and miss out on gains. But the idea that the stock market always goes up and you just need to buy and hold a diverse basket of stocks and bonds, it's just ridiculous. I mean, if you look at Japan, their market just broke even. I probably mentioned this before, but it bears noting again that their market topped out in 1989. So 35 years later, it got back to even. The Shanghai Composite Index is down about 40% since 2007. That's 17 years ago. So unless you think the laws of supply and demand are different here in this country than they are in every other nation on the planet Earth. I mean, by the way, we've had lost decades here in the 30s and 40s and in the 70s. So you just can't buy and hold a bunch of stocks in a diversified portfolio in these target date funds and hope that your retirement is going to be sound. I just won't do that. Again, I've learned through my multi-decades of managing money, you have to be smarter. And that's why I created my inflation, deflation, and economic cycle portfolio. And it tells me when I need to get nervous about the stock market based upon the scoring of that model. Right now, I'm on high alert. Not high alert. I'm on alert because of the valuations of the stock market, because of the liquidity impulse, because of what the Fed has done, because of positive real interest rates, because of the ending of the BTFP, because of the reverse repo facility, because of the insolvent condition of the United States of America. There's a lot of things to worry about. The fact that most of the gains are in a handful of stocks. The fact that the stock market is at 185% of GDP, which is unprecedented prior to 2020. Never, not even 1929, or the year 2000, or the year 2007 was the stock market, the valuation of stocks compared to the economy, ever close to 185% of GDP. Never. But it is today. So if you're not worried, then you're either stupid or ignorant. I don't want to be either one of those things. So getting the timing right is crucial, and that's why I come on your program. I am not. You're going to ask me. I can feel you ask me. Well, are you short yet, Michael? No, I am not net short the market yet. I have only one short, and that's in high yield, and it's at 2%. So I have no direct shorts in the market, but I'm anxiously waiting to put more shorts on. I'm patiently waiting and anxiously waiting to put more shorts on. But I'm going to do it when the market is ready to fall, not when I read some headline and get nervous and hit the sell button.
What do you think of Hemke's way of trading the bull market? Are you actively trading your positions, or do you just stack and hold? Post it in the comment section down below. Subscribe if you have not yet done so, and watch this video right here because you'll love it. I see you on the other side.